The biggest danger to the American economy is not the thing most people argue about at dinner, post about online, or blame every election cycle. It is not artificial intelligence replacing jobs overnight. It is not whichever politician happens to be standing behind a podium this week. The real threat is quieter than all of that, and that is exactly why it matters. It is the kind of story people skip because it sounds technical, dry, and painfully boring. But sometimes the most dangerous force in finance is the one that never needs attention because it has been holding the system together for so long that everyone assumes it always will. And right now, one of those hidden supports is starting to move. If you have spent the last year wondering why mortgage rates feel stuck, why markets can swing from calm to panic with no obvious trigger, and why the Federal Reserve can talk about relief while financial conditions still feel tight, the answer may not be sitting in Washington at all. It may be sitting thousands of miles away inside a market most Americans never think about, a market in Japan that has quietly shaped the cost of money around the world for decades. That sounds strange at first because Japan is not usually the country Americans picture when they think about what determines their monthly mortgage payment, stock valuations, or borrowing costs. People think about Wall Street. They think about the Federal. They think about Congress, deficits, inflation, and maybe China if they're trying to sound global. But for a very long time, Japan has played a role in the global financial system that is much bigger than most people realize. Not because it dominated headlines, not because it was the loudest economy, but because it became the source of some of the cheapest money on Earth. And when the cheapest money on Earth starts becoming less cheap, the consequences do not stay local. They spread everywhere. They spread through bonds, currencies, stocks, housing, business lending, and eventually into ordinary life in ways most people never connect back to their origin. To understand why this matters so much, you have to go back several decades, to the moment when Japan stopped looking like the unstoppable future and started looking like a warning. In the late 80s and early 90s, Japan's asset bubble burst in spectacular fashion. Stock prices collapsed. Real estate prices fell hard. Confidence cracked. What followed was not one bad year or one ugly recession. It was a long, exhausting era of weak growth, stagnant wages, low inflation, and repeated failed attempts to restart real momentum. Economists later called it the lost decades, which is an almost too gentle phrase for what it meant. Imagine a major economy spending years trying to reignite itself and never quite getting there. That was Japan. It was not total collapse. It was something in some ways more difficult. Long-term economic numbness. And when an economy gets stuck like that, central banks start doing unusual things. The Bank of Japan pushed interest rates lower and lower in an attempt to encourage borrowing, spending, and investment. Eventually, rates were not just low. They were practically pinned to the floor. Then they went negative. And when even that did not fully solve the problem, Japan moved into even stranger territory. The central bank began actively managing long-term government bond yields, essentially stepping into the market and saying, "We are not going to let these rates rise the way they otherwise might." For years, the message was simple. Money in Japan would remain extraordinarily cheap. Japanese government bonds would remain extraordinarily low-yielding. And that decision did not just affect domestic savers. It reshaped global capital flows. Think about it from the point of view of a large investor inside Japan. Maybe you run a pension fund. Maybe you manage money for an insurance company. Maybe you're overseeing reserves for an institution that needs returns, not just safety. You have obligations. You have future payments to make. You cannot sit around earning nothing forever. But your own bond market is giving you almost nothing. So what do? You start looking elsewhere. You start looking at the United States. You look at Treasury bonds. You look at mortgage-backed securities. You look at corporate debt. You look at equities. You look at real estate. You look at any place where returns are meaningfully higher than what you can get at home. And because Japan's rate stayed so low for so long, this was not a short-term burst of overseas buying. It became a structural habit. Japan became one of the largest international suppliers of capital to the rest of the world, and especially to the United States. There is another layer to this, and it is where the story really gets powerful. It was not only that Japanese investors were buying foreign assets. It was that global investors everywhere learned to use Japan as a funding source. If you could borrow in yen at extremely low cost and then move that money into higher-yielding assets somewhere else, you had a trade that looked almost irresistible. Borrow cheap in Japan. Invest where returns are higher. Pocket the difference. It sounds simple because, at its core, it is simple. But simple does not mean small. When institutions do this at massive scale, it becomes one of the most important liquidity engines in the world. Imagine a large hedge fund, a bank treasury desk, or a sophisticated global macro investor. They borrow in yen because the cost of borrowing is tiny. They convert that money into dollars. Then they buy U.S. treasuries yielding meaningfully more, or maybe investment-grade corporate bonds, or dividend-paying equities, or mortgage debt, or even assets in emerging markets if they want more yield. As long as the funding stays cheap and the currency risk stays manageable, the spread is attractive. And when enough investors repeat the same logic over and over again, it does something profound. It pushes more money into global assets. It supports valuations. It suppresses yields. It increases liquidity. It makes risk assets feel easier to own than they otherwise would be. This is one reason the financial system can look stronger and more stable than it really is. Hidden underneath, it is a giant funding mechanism most people never see. For years, that mechanism worked because it rested on an assumption that felt almost permanent. Japan would remain a low-rate world. Japanese yields would remain pinned down. Borrowing in yen would remain cheap. The cost of hedging those foreign investments would remain manageable enough. That assumption became so deeply embedded in the financial system that people stopped treating it as a fragile condition and started treating it like background reality. That is one of the most dangerous things in finance. When a condition lasts long enough, people stop seeing it as a condition. They start seeing it as nature. But financial nature is often just a temporary arrangement that survived longer than expected. Now the arrangement is changing. Japan is no longer operating in exactly the same world. Inflation pressures have shifted. The Bank of Japan has moved away from the most extreme version of its old policies. Yield curve control, which once held Japanese bond yields down like a weight tied to the market, has been weakened and then effectively abandoned as a defining framework. Interest rates have started rising after years of being near zero. That may sound small to someone used to U.S. financial headlines, but in the context of Japan, it is a major change. And because the entire global carry system depended on Japan being permanently cheap, even a modest shift matters. This is where the story moves from academic to personal. When Japanese yields rise, two things begin to happen at the same time. First, the appeal of sending capital abroad starts to weaken because domestic returns are no longer laughably low. Second, the math behind borrowing in yen to buy foreign assets becomes less attractive. Funding costs rise. Hedging costs can become more painful. What used to be a comfortable spread starts shrinking. And when the spread shrinks, the behavior changes. Money that once flowed outward starts slowing down. In some cases, it starts coming home. That process is called repatriation, and it sounds harmless until you realize how much of the global financial system got used to Japan exporting capital instead of pulling it back. For decades, Japanese money helped absorb U.S. debt. Japanese institutions were major buyers of treasuries and other American assets. They were not doing America a favor out of goodwill. They were responding to incentives. But the effect was the same. Their demand helped support bond prices and helped keep yields lower than they otherwise might have been. And that mattered because U.S. long-term rates are not set by Jerome Powell the way a lot of people casually imagine. This is one of the biggest misunderstandings in modern finance. People hear the Fed is cutting rates, or the Fed may cut rates, and assume that means borrowing costs across the economy should naturally come down. But the Fed directly controls only the short end, the policy rate, the overnight benchmark. Longer-term yields, like the 10-year Treasury, the 20-year, the 30-year, are shaped by market forces. Supply and demand, inflation expectations, term premium, global capital flows, buyer appetite, deficit issuance. All of that matters. So you can live in a world where the Fed eases policy, but long-term yields do not fall the way people expect. And if long-term yields stay elevated, the parts of the economy most people care about, mortgages, corporate financing, valuation multiples, do not get the relief they were waiting for. That is where Japan comes back into the story. Because when one of the world's most persistent sources of demand for long-duration foreign assets becomes less enthusiastic, the market has to find another buyer. And if demand softens while U.S. debt supply remains enormous, yields have to rise high enough to attract that next buyer. That is not ideology. That is not politics. That is bond math. And bond math eventually reaches everything. Start with housing, because this is where a lot of viewers actually feel the issue. Mortgage rates are heavily influenced by long-term Treasury yields, especially the 10-year. So if the Fed cuts short rates, but the 10-year stays elevated because global demand for long-term U.S. debt is weaker than before, then mortgage rates stay stubborn. Home affordability stays crushed. Existing homeowners stay locked in because refinancing makes no sense. Buyers hesitate. Transaction volume freezes. Builders face a trickier environment. People keep asking why housing still feels broken even when they hear soothing language about inflation cooling or the Fed getting closer to easing. This is one reason. The long end is not obeying the story. Now look at equities. Stock prices are not pulled out of the air. At a deep level, markets are always making a judgment about future cash flows and discounting them back into the present. When long-term yields are high, future earnings are worth less in present terms. That compresses valuations, especially for growth companies whose profits are expected further out in time. That is one reason markets can look shaky even when economic headlines are not apocalyptic. The issue is not always earnings collapse. Sometimes the issue is simply that the price investors are willing to pay for those earnings has changed because the baseline cost of money has changed. Then there's corporate credit. When money is abundant and financing is easy, companies refinance freely, expand more confidently, chase acquisitions, tolerate weaker balance sheets, and generally operate in a more forgiving world. When long-term rates stay high, refinancing gets more expensive. Weak business models get exposed faster. Expansion slows. Risk appetite shrinks. Firms that looked fine in a cheap money world suddenly look much more vulnerable. Again, the average person may not trace that back to Japanese yields, but the chain is real. Cheap Japanese funding fed global liquidity. Less cheap Japanese funding means tighter conditions worldwide. And this is the uncomfortable part most people do not want to hear. A huge portion of what Americans took for granted in modern markets was supported by a hidden international arrangement they did not know existed. For years, the United States benefited from foreign demand for its debt, from a global search for yield, and from Japan's ultra-loose monetary stance that helped push money outward into higher return markets. That helped make American asset prices look stronger, borrowing conditions look easier, and long-term financing more manageable than it otherwise might have been. It was like living in a house with a support column in the basement that nobody ever checked because the ceiling had never cracked before. Now, the column is shifting, and people are looking around wondering why the floor feels unstable. The reason this story gets so little attention is simple. It is not emotionally cinematic. There is no villain in a dramatic speech, no instantly recognizable scandal, no culture war hook, just bonds, yield differentials, capital flows, repatriation, term structure, and market plumbing. But market plumbing is where the real pressure builds. Most of the time, by the time the public notices a macro problem, the underlying mechanics have already been moving for months or years. And this is also why mainstream financial conversation often feels so useless. It keeps people focused on the loud variable and ignores the structural one. It treats every market move like a direct reaction to Fed language, as if the entire global system is just waiting for one sentence from Powell to determine where mortgage rates go next. But the world is bigger than that. If Japan's institutions have a more attractive home market, if hedging becomes more expensive, if U.S. Treasury supply keeps rising, if fewer price-insensitive foreign buyers are willing to absorb duration the way they used to, then the long end behaves differently, and all the headlines about easing conditions start sounding disconnected from lived financial reality. Here is another way to think about it. The world has spent decades building financial expectations around the assumption that somewhere, somehow, there would always be a large pool of cheap capital willing to chase yield. Japan was central to that assumption, not the only force, but one of the most important ones. When that assumption weakens, markets do not just calmly reprice in a straight line. They become more fragile because a hidden certainty is being removed. Investors who built strategies on cheap yen funding have to reassess. Institutions with unhedged or partially hedged exposures have to reassess. Foreign bond allocations have to be reconsidered. Even if nobody panics, the structure changes. And structure is what really determines whether a market feels easy or hard. This is the perfect point to say something important. If you care about understanding the forces beneath the headlines, subscribe to the channel. Because most people only get the surface-level version of finance. They hear about rates, inflation, and markets as disconnected stories. But the real changes usually happen where systems overlap, where one country's policy becomes another country's cost of capital, where a boring shift in bond yields can reshape housing, stocks, and lending without ever becoming a trending topic. That is exactly the kind of story worth paying attention to. Now let's dig even deeper into why Japanese capital mattered so much. Japan is not just another country holding some treasuries. It has long been one of the largest net creditor nations in the world. That means it accumulated enormous claims on the rest of the global system. It saved heavily. It invested abroad heavily. It became, in effect, one of the world's great suppliers of financial oxygen. That matters because U.S. debt markets do not just need buyers in an abstract sense. They need reliable, large-scale buyers willing to own long-duration paper in meaningful size. Japan fit that role. And when one of the most dependable buyers becomes more selective, markets do not glide through that change painlessly. You can see this in the yield curve itself. If short-term rates fall because the Fed eases, but long-term rates remain elevated because investors demand more compensation to hold duration, the curve steepens. To most people, that sounds like a technical chart issue, but it is actually one of the most revealing signs in macro finance. It tells you the market is not convinced that easier policy solves the deeper funding problem. It tells you that long-term debt still needs a higher return to clear. It tells you that the plumbing is under pressure. This is also why someone like Ray Dalio has spent so much time emphasizing that the bond market is the foundation beneath everything else. When people obsess over stocks alone, they miss the more basic layer. Bonds set the benchmark. They define the cost of money. They influence everything from equity multiples to housing to business investment to government financing. If the bond market becomes harder to stabilize because the historical buyer base is changing, then everything built on top of it becomes less stable too. And the United States is not making this easier on itself. Debt issuance remains massive. Fiscal needs remain enormous. The supply of Treasury paper is not slowing enough to offset weak demand. So even a modest change in foreign appetite matters disproportionately when the government needs to issue at scale. This is one reason the problem feels so structural. It is not just that Japan is changing. It is that the United States has become deeply dependent on large and ongoing absorption of debt at a time, when one of the old sources of demand may be less reliable. This is where viewers need to understand something uncomfortable. The financial system can stay functional while becoming less forgiving. It does not need to break in some cinematic way for life to get harder. That is one of the biggest mistakes people make when thinking about macro risk. They imagine either smooth stability or obvious crisis. But a lot of real damage happens in between those extremes. Mortgage rates stay high enough to freeze people out. Valuations stay pressured enough to create fragile markets. Credit stays expensive enough to slow business formation and expansion. Government debt becomes more costly to finance. The economy keeps moving, but the friction rises everywhere. That kind of environment is brutal precisely because it is not dramatic enough for people to organize around. It just feels like nothing fully improves. Homeownership remains difficult. Market rallies feel less trustworthy. Borrowing stays expensive. Relief always seems one policy meeting away and yet never fully arrives. That is the kind of world you get when hidden structural supports weaken without fully collapsing. So when people ask, why is everything still tight even though inflation is not what it was, even though the Fed may be closer to cuts, even though markets keep saying easing is coming, part of the answer is this, because the long end of the system is dealing with forces much bigger than a press conference. Because one of the world's oldest, cheapest funding engines is no longer as stable as it once was. Because Japanese yields rising is not a local curiosity. It is a global repricing event. And this is exactly why the quiet risks are often the most dangerous. Everyone sees the loud threats. Elections, AI, trade wars, recession calls. Those are visible. Markets talk about them all day. But the risks that truly reshape systems are often the boring ones. The subtle funding change, the shift in bond demand, the repatriation wave, the deterioration in a structure that once seemed permanent. Those are harder to narrate, harder to monetize in media, and easier to ignore until they start showing up in everything. Here is the deeper lesson underneath all of this. Financial systems are not held together by headlines. They are held together by incentives. If incentives change, capital changes direction. If capital changes direction, prices change. If prices change, lives change. Japan's old policy regime created incentives that helped subsidize global risk-taking and global bond demand for decades. The new environment is changing those incentives. And that means the world has to reprice a reality it got used to for too long. So what does all of this mean in practical terms? It means you should stop assuming the Fed is the only story. It means you should stop treating mortgage rates as something that should automatically collapse the moment Powell softens his tone. It means you should understand that long-duration debt markets are driven by global demand, and global demand is shaped by forces most American coverage barely touches. It means you should be more cautious about narratives that promise easy financial relief from a single policy pivot. And it means you should pay attention to the quiet parts of the system, because that is where the real strain builds first. The loudest risks in markets are often already visible, debated, and partly priced in. The dangerous ones are the ones hiding in plain sight, disguised as technical background noise. Japanese government bonds, currency hedging costs, repatriation flows, Treasury demand, term premium. These are not just niche topics for traders in expensive jackets. They are the hidden machinery behind why America's financial life still feels so heavy. So the next time someone tells you the answer to everything is just wait for the Fed, remember this story. Remember that capital has a history. Remember that the cheapest money in the world helped shape the price of nearly everything for a generation. And remember that when that cheap money starts going away, the effects do not stay trapped in Tokyo. They travel through bond markets, into mortgages, into stocks, into business loans, into household budgets, and finally into the feeling that the economy is much tighter than the headlines say it should be. That is the real story. Not the loudest one, not the most clickable one, but the one that explains why the system still feels financially suffocating even when the public conversation keeps promising relief. If this changed the way you see the economy, subscribe and turn on notifications, because the most important forces in markets are usually the ones nobody is packaging clearly. And if you want the next step after this, the obvious follow-up is understanding how rising Treasury yields, global debt issuance, and central bank policy together shape the future of housing, stocks, and the dollar. That is where this story gets even more important.